Well, like a good game of darts. There are misses, and there are hits. But experienced players know that even when you miss, you can still win.
Bullseye.
Biggie, the finance geek.
With investing, you may have heard the advice that when the market goes up and down, the best thing you can do is to continue to put money in the market. Why would you do this though? Is this one of those things that we were told but may not be right, but everyone just goes along with it anyway, like walking a cat? The answer is that it is good, because you're taking advantage of something called dollar cost averaging. This is one of the best strategies you can do in investing. The idea is that we don't know what's going to happen in the market. There are always ups and downs when investing, so you continue to invest the same amount no matter what happens. The market goes down, you invest. The market goes up, you invest. And the cycle continues. Think of it like hiking up a hill range. You're going to have a lot of ups and downs, but if you keep walking, eventually you'll make it up the hill. Now, I don't know about you, but I have no clue what the future holds. Most of the time, I walk out my door and expect my day to go a certain way, only for reality to roll up and blindside me in the face. Can I help you?
You got money?
Yeah, I got money.
I'm gonna need that. You know, actually, I like that watch too.
All right.
And the bracelets, actually. And you know what? Actually,
That is why dollar cost averaging is so important to investing. Nobody, and I mean nobody, knows what's going to happen in the market. Honestly, the best anybody can do is make an educated guess. Even the best investors in the world admit that nobody can predict 100% of the time what's going to happen in the market. So dollar cost averaging helps you over time. There'll be ups, there'll be downs, but since you're putting money away regardless, then your investments, generally speaking, will end up positive over time. And that will help you sleep better at night. It's like putting a lot of plants in the ground and expecting some of them to bear fruit, and some not to. You still get a good harvest when you anticipate the possible losses and plan extra just in case. So here's how it works. So let's say Luigi invested in a company that trains giant turtles for people to ride on. He decides to invest $100 each month into the company no matter what. So for the first month, he invested $100 and was able to buy 5 shares for a total of 5 shares. Now let's say the company had a great month and the stock grew to $50 a share. He still invested the $100 though and was able to buy 2 more shares for a total of 7 shares. Now let's say that the next month the company found out that the turtles are mostly aquatic. And it turns out that they can't really run well on the ground. Well, because of this setback, the company's share declines to $10 per share. Well, Luigi still invests $100, and now because the company's stock is cheaper, he's able to buy 10 shares. And that brings his total to 17 total shares. Now say there's a month 4. If the shares manage to recover right where you bought in, that $20, so although the stock price didn't increase from where it started, Luigi ended up still making money because he was always buying shares the whole time. So because Luigi kept consistently investing, and although the stock price is still the same of when he bought in, he invested $300 total, and yet his money grew to $340 because he was consistently investing in. Well, that's our show. Thanks for watching. And remember, the tortoise won the race with a steady walk. Sometimes that's what it takes to win the race. Unless, it turns out to be a turtle. We'll see you next time. That's our show. Thanks for watching. If you enjoyed this video, please consider following. And if you think we can assist you in any of your financial endeavors, please feel free to contact us. Our information is in the description below. Thank you, and we'll see you next time.